Yo, man, what's poppin', Black Money Mindset family, man? We back with another one, man. Like I told y'all, man, raw and uncut on this channel, man. Appreciate y'all for continuing to rock with me on this channel. Today, man, we got a topic, man. I'm finna tell y'all just about how I got started investing and how you could get started at a young age investing and everything like that, man. So I just want to start out by saying and telling y'all the, you know what I'm saying, the normal traditional way that people don't really know what they talking about, you know what I'm saying, say to invest. Well, you know what I'm saying, this way that I'm about to tell y'all is proven to over time do you well over great returns. You know what I'm saying? I'd say it's average returns. But that method is the Warren Buffett method and the dollar cost average into SPY, S&P 500, ETFs, all kind of ETFs, VOO, like all these type of long-term ETFs. That's the norm. That's the average way to invest. That's not the way that I'm finna teach y'all today, but I feel like in the next couple of years, I will be just doing that in a side account just because it is proven year over year over year to yield you a great return, better return to you, you know what I'm saying, holding your money in a bank account. But it, in my opinion, is not the best way to get started investment at all. So if you want to do, you know what I'm saying, do your research on that method, it is called the dollar cost average method, the ETF method, whatever you want to call it. It's, you know what I'm saying, it's a boring method way to invest, but it is proven. I wouldn't say to just completely ignore it. You know what I'm saying? It is a great way to invest, a great way to get started if you don't really know what to do when you started investing, because the S&P 500 and these ETFs, they hold individual growth stocks inside them that you're an invest. So you're basically investing in the top companies in the world, like at the time or stuff like that. Like SPY drops and adds companies to the S&P 500 to you know what I'm saying, make up the most valuable 500 companies in the world or something like that. So that's what that is, and that's what you'll be doing if you do decide to invest in the S&P 500 and just dollar cost average to ETFs like VOO. Is different sectors of ETFs that you can invest in, which is a great way to start investing. But I'm gonna tell you why it's not what I do and why you shouldn't, especially right now, start doing that. So the reason that you should not just start doing that right now, in my opinion, is because we are at highs. We are at highs right now. It is not time to be dollar cost. You're gonna dollar cost average into highs. You're gonna build your position into highs. We are due for a pullback. One thing about the market is it's going to pull back. It's been proven to pull back the same way the S&P 500 has been proven to yield a return year over year. The market has, it's the same way the market has been proven to pull back after reaching highs and being overextended, bro. So right now we're kind of overextended, so I would not suggest that method right now, bro, because you're gonna dollar cost average. So basically the method is just to buy consistently over a period of time. That's basically what dollar cost averaging is. Just consistently buying weekly, monthly, consistently buying no matter what the price is at. But why I say that is not a good idea right now, and why you should not do that right now, especially at a young age, is because you're probably gonna get discouraged when the market pulls back and you lose all the money that you put in there. Of course, they just dollar cost average, so you're supposed to be adding in on the way down and things like that. But just still, the market is due for a pullback. You got to understand the market. You got to do your research about the market to know that it's going to pull back. If it's overextended, if it keeps going up crazy, it's going to pull back. It's proven to pull back. It's always proven to pull back. So it's going to pull back. You have to believe that. You have to trust in the market trends, just like you trusted in dollar cost average in the market that is going to go up. You got to know that when it get overextended and it's going up for a while, that it's going to have to pull back. And so why I say that is just I wouldn't invest in that junk like right now. I wouldn't even put my money and time into just dollar cost averaging, coming up with a plan for that. I would wait for a big dip, like a big 20%, 15. Obviously you cannot time the market, bro. I'm gonna just tell y'all that right now. Don't try to time the market. I try to time the market and things like that, especially with options trading and stuff like that. You will get burnt, but don't try to time the market, but just wait for a pullback. Wait for pullbacks to invest. You can dollar cost average into pullbacks. Like say SPY has a 10% dip on a given day. Like that's when you start. That's when you unleash your weekly amounts in, bro. Like that's what I would be doing, and that's my way to start investing. But I'm gonna tell y'all exactly what to use to invest, how you can really get started investing. And one app that I recommend is off the rip is Acorns. If you don't know anything about investment, if you don't know anything about brokerages and how to invest, how to do anything like that, then I would suggest you starting with Acorns. There's a growth there is a growth calculator on there where you can literally see the growth of companies, and no, not the growth of companies, but the growth of you investing into companies. And basically what they're going to do is they're going to take your money and dollar cost average it, honestly. But it's a very, you can set your account to growth or whatever. It's called Acorns, but you can set it to aggressive, non-aggressive account and things like that, so it invests it differently. But I would say that's the best way to start if you have no experience investing at all. And but for me, I use brokerages like Robinhood, Thinkorswim, Webull, things like that, because I'm a personal investor. I research my companies and I do what I do. And let me just show y'all why I've been talking too much of like how I grew an account, bro. I grew an account. This account was at $700, bro, and this was a while ago. This is when I first started investing, bro. So this account was at $700, and now look at it, bro. You know what I'm saying? Now look at it, $6,000, $6,000. You know what I'm saying? And that was a while ago in one account, bro. Mind you, I use my accounts. I use Thinkorswim for well, Robinhood was where I first started off. That was a screenshot when I first started out, and I was using Robinhood because it's the most easiest to use, easy interface and things like that. But started using Webull, started using, you know what I'm saying, Thinkorswim. That's a more advanced program where you can start trading and everything like that. But the truth of the matter is, bro, you gotta learn how to start investing. You gotta start investing young, bro. Whenever you can, bro. The earliest that you can start investing is start investing right now. Like if you watching this video and you ain't got no money invested, invest right now. Get you a broker's account, get on Acorns, get on Webull, get on motherfucking Robinhood, and start trial and error with these. I ain't gonna lie, you're gonna have to go through a period of trial and error and learning the market, because I wouldn't know what I know right now about the market has to pull back if I didn't do my research. And I tried dollar cost averaging in the beginning, bro. So I'm speaking from experience. It's just stuff that I wouldn't necessarily do if I was starting out. But teach his own, you know what I'm saying? You do what you want to do, and it's not a bad method to dollar cost average. But I just want to tell y'all those couple of apps. Acorns is a great one if you have no experience, because you don't have to do anything at all. They will invest your money for you. You just set if you want to go weekly, daily, monthly, anything like that. So you just set it up in that way, and then it just does all the work for you, and it just basically invests into bonds, stocks, bonds, everything like that. So Acorns is a really good app for that. You can see your growth potential on there. It's a great platform for that. And then if you know how to research your stocks, which I will be talking about on this channel as well, then I would recommend Robinhood. Easy interface, you can, know what I'm saying, easy to use, easy to buy and sell. And then like I said, Thinkorswim and Webull if you want to get advanced, start trading and things like that. But yeah, man, so you do have, I would say this is the #1 method that I use. It's called buying on the dip, bro. Buying profitable companies that are proven profitable on a dip. Never buy, bro. Look, this is what you got to do, bro. Look at your 52-week high of the company. Whatever company you're looking at to try to invest in, look at the 52-week high. And as farthest away from that 52-week high you can get, that's when you want to buy it, bro. That's it. That's when you want to start dollar cost average. If it's $10 away from its let's just say all right, let's just take a random stock, you know what I'm saying, let's say Apple's at 52-week highs $50, which is nowhere near, but let's say Apple's 52-week high is $50, and they got a pullback, a super pullback. Let's say their 52-week high is $50 and their 52-week low is $25. So let's say Apple has a crazy pullback and they're at $30. That's when you want to start averaging in to Apple at that point. You know what I'm saying? Because you're gonna get close. You want to get as closest to that 52-week low as you can, and you want to start buying these stocks, man. That's how you do it, bro. That's how you got to do it. Obviously, you got to see if the company is profitable. You got to run balance sheets on there, and just look at the company's profit year over year, quarter over quarter. And the number one rule, bro, you can't go wrong with buying a dip. You can't go wrong with buying as closest to that 52-week low as possible. Don't just go putting all your money in at when the hype, because once you start hearing about companies like Nvidia, bro, once everybody started hearing about Nvidia, it was too late to invest, bro. You would have got killed if you would have invested. It's just too late. Once Nvidia was at before they stock split, motherfucking $600 and stuff like that, it was too late to invest, bro. Way too late to invest, bro, because you're gonna feel the downside of that too. It's gonna pull back, just like everything, bro. I seen somebody, they was like, yeah, man, Nvidia's going crazy, man. I'm about to put a lot of money in it. Next day, Nvidia pulled back $30, bro. So, like, and the guy that bought it when it was at $100, he don't care about that $30 pullback because that's healthy, and he realized that he got in at a good average. So all I'm telling y'all is to get in at a good average. Don't just go randomly putting your money in and thinking that it's going to keep going up forever, bro. Like, it's not. Like, you gotta understand that stocks get overextended, market gets overextended, and everything is going to pull back. So wait on your opportunities to pull back. Use you know what I'm saying, apps like Acorns if you don't know how to invest. Like, you can use that while you're learning to invest, and then use Robinhood, Webull, and Thinkorswim if you want to get super advanced with your investments and you want to start researching your companies by yourself, which I will be talking about on this channel too. So make sure you subscribe, man. I hope y'all enjoyed this video, man. I'm gonna catch y'all on the next one.